welcome to this special edition of the Global View with me, Tanvir Gill. My guest today on the show is a veteran fund manager and an emerging market star. Dr. Mobius joins me to put the globe in perspective. Dr. Mobius, thanks very much for taking out the time. It's great to have you on the show. Let me start off with the topic at hand, which is the upcoming Fed policy meet. Now, you have stated in the past that you believe the Fed should not go ahead with a rate hike, given the outlook on inflation being bleak. However, the optimists believe that there's a lot that's looking up in the U.S. economy, whether it's the growth numbers, consumer spending, corporate earnings, the jobs market data, and that would be reason enough to for the Fed to actually prepare on a liftoff and give the markets a token rate hike that would put the markets at ease as well. Is that not a convincing enough argument for you to believe that the Fed can actually give the markets that rate hike come Thursday?
Well, I think they should pay more attention to inflation. I realize that they're worried about other factors in the economy. They want to have high employment. They want to have good economic growth. And if those things are doing well, then they sort of want to jump the gun and preempt any rise in inflation. But I think the focus should be on inflation first. And it's a 50-50 chance of them raising rates. If they do, it will probably be very, very small. I think they'll be very cautious.
So you're not completely ruling out a no rate hike in the next 4 days?
No, I'm not ruling it out because they stated, as you know, earlier this year that they will raise rates sometime this year. So it's very difficult for them not to do what they said they will do. Although, as you know, some of the Fed governors are against a rate hike.
But, you know, December is also part of this year. What do you think the markets would do if there is no rate hike, in this policy meet and it's postponed perhaps down to 3 months? What do you think the markets would do in the interim?
Actually, it's really interesting when you figure that if they don't move on rate hikes, then the market may be really more uncertain because they will expect then a rate hike next year. So in some ways, for the market uncertainty to be absolved, it's better that they raise rates now, because then the market will say, okay, it's happened, we can move on. I think the problem now is the great uncertainty about what is going to happen.
Sure, Dr. Mobius, how do you think the markets would react then to a rate hike when it happens? Because in the past, we've seen traditionally, post the event, the markets rallying, barring, of course, 1994. Do you believe that that would be the case this time too?
I think if there is such a recovery, it would be very temporary. A tremendous amount of money has left the markets, particularly emerging markets around the world. And this has not yet happened in the U.S. market, and it is happening as we speak. There's been definitely a break in the indices. Indices have broken down. So I expect maybe there'll be more corrections along the way, and then perhaps next year some recovery. But this rate hike, of course, over the longer term, if they continue rate hikes, then this would not be good for markets generally.
Do you believe that the U.S. is on strong footing? The internals of the economy are looking good, barring inflation?
I believe so. I think the U.S. economy is in pretty good shape. A lot depends on what happens with a change of administration. If there's a Republican administration coming in the U.S., you may see a stronger economy because their emphasis will be on cutting government spending, cutting taxes, which will generally be good for the economy.
Dr. Mobius, what happens to the dollar trade then? Because the rally has extended itself out. With the rate hike, one believes that the dollar will only get stronger, and that would not be a very positive scenario, given that the U.S. would also want to protect its exports.
As you can see, there have already been some discounting, as I mentioned, and that's the reason why the U.S. dollar has gotten stronger against other currencies. I believe we have reached the point for many currencies where a continuing devaluation against the U.S. dollar is not warranted and probably will not happen because of the fact that they've already preempted this possible rate hike. Going forward, however, if rates in America keep on moving up, then you'll see a retreat, further retreat from other currencies. And I don't think the Fed will want that to happen and for this dissonance between other currencies around the world and the U.S. dollar to be created to such a degree.
So then characterize the fall that we are seeing over the last 3 weeks. It's been extremely volatile for the markets, extremely vulnerable. You know, we're keeping one eye on China, one eye on the US Federal Reserve. And of course, you know, all that talk about deflation is also taking center stage. Do you think this correction that we've seen in the market, and correct me if I'm wrong, I mean, would you qualify it as a correction, or do you believe that this is the start of a bear market? Because we've seen the markets actually rally on the back of accommodative monetary policy for over 6 years.
Well, if you look at China, they are definitely in a bear market. They've reached far beyond the 30% decline, which is defined as a bear market. So I think we are in emerging markets as well into a bear market. Now, these bear markets, you must remember, don't last very long. They last for maybe 1 year at most. Then you see the recovery. And we're well into 5-6 months of this bear market territory. So I think we can look forward next year, perhaps some recovery, again, provided that these interest rates environments do not create so much uncertainty. In other words, where the central banks around the world are very clear about what they're going to do and when they're going to do it.
And what about emerging markets? Because those assets have come off substantially as well. Do you think that there's an opportunity in this sell-off, or there's a structural problem? I mean, we've seen Brazil get downgraded to junk. We've seen Russia get downgraded to junk. There's concern about Turkey as well. You know, we'll talk about India later. But do you believe that there's a structural problem in lack of growth as well as high debt that's plaguing emerging markets? And so it's, you know, even if the US does well, you know, you might just see a flight of safety to the US and to other developed market assets versus emerging markets.
Oh, there's no question. Emerging markets are in trouble. And we've seen roughly about 50 billion of emerging market fund money go out the door in emerging markets. So there's no question about that. But as I mentioned, recovery can come very fast, because if you see the US economy doing well, then that will drag the rest of the world economies up, and particularly emerging markets. The volatility of emerging markets is very great. So you can have a lot of downside, as we've seen, but then the upside can be quite dramatic. So I think we have to watch it. Don't forget, emerging markets are still growing at about double the rate of developed countries. So even with the downgrades you see in Brazil, problems in Russia, etc., you have India that's doing quite well. China is doing very well. Don't forget, even at 6 or 7% growth, China is growing at a tremendous pace.
Right. So then what do you make of the fall in EM currencies? Because that seems structural and pretty much the epicenter of the problem in EMs.
Well, I think most of these currencies have reached the point where they're severely undervalued against the US dollar. So further declines may be maybe 5–10%, but not much more than that. And then you're going to see recovery, and some of these lower and cheaper currencies are going to be good for exports in many of these countries. So I think it's a very interesting development. With the lower price of oil and lower commodity prices, of course, by and large, emerging countries are doing well, because most of them are importers of these commodities. A few of them, of course, are dependent upon commodity exports, but generally speaking, it's been good for emerging markets.
Right. So then how are EM allocations being kind of structured right now? You know, because we've been talking about the EM universe by itself decoupling. So it's pretty much each emerging market for itself, the good EMs versus the bad EMs. Do you believe at this point in time that allocations are very country specific?
Very country specific, and more importantly, very company specific, because some of the companies in emerging markets are doing very, very well, even in countries where you've seen a big decline in the markets. And there are great opportunities looking at specific companies and some sectors, by the way. Some of the sectors have really come down dramatically, and there's a good opportunity.
Right. Has the redemption pressure from EM funds abated a bit over the last couple of days? Do you get that sense? And are allocations increasing towards the perhaps relatively healthier emerging markets like India and China?
Yes, of course, there's more emphasis on India and China, particularly India. But of course, as you know, India has a number of reforms that have to be implemented. Modi is having difficulty getting passage of some of the bills he wants passed, but whatever he's done, it's been very positive. And we think going forward that some of the countries that have been hit hardest may be the ones that we'll see faster recovery. Brazil would be a good example where it's so down that there are opportunities in the field that we have to be very careful about.
You know, your own emerging market fund has a 14% weightage in India. Given the MSCI EM index, the weightage is about 7% whereabouts. On the global index benchmark, it's just less than 1% for India. Do you think perhaps a lot of fund managers would build positions both in EM funds as well as global funds for India?
I think you're going to see more money coming in, provided that the tax situation is clarified. As you know, the retroactive tax issue and other tax issues are very frightening for
sure, but that has
fund
been
managers
clarified.
like ourselves. So we think that that would be very positive if it's very much clarified, and you'll see more money coming in. You must remember that many of the funds like ours are sitting on lots of cash. So we're ready to invest, and we'll be going into India once these issues are clarified.
Oh, yes, indeed. I understand that you're sitting on 20% cash in your EM fund, and you would be looking to deploy a chunk of that money in India, you believe?
Definitely, yes.
But, you know, on the retrospective tax issue, the government has pretty much made its stance clear. So, you know, that exemption holds. Are foreign investors still worried about the uncertainty in the tax regime?
I think there is a need for more legislation to have this sort of cut in stone. So that is very, very clear to everyone what they can expect going forward. But yes, the recent clarifications have been helpful, and they've been taken on board by many of the foreign investors.
Right. And specifically, you know, in terms of, you know, what the finance minister is saying about India all along over the last 2 weeks, he's saying that, you know, given the pressure in China, India could be perhaps the growth engine of the world. Is there a shift that you see in the perception of India as a key emerging market where growth is pretty much a given?
Yes, I believe that India will probably surpass China in terms of economic growth. As you know, India is a smaller economy than China, so the base is smaller, and the percentage change can be much greater. And also, India, I would say, maybe 3 or 4 years behind China in terms of its economic growth characteristics. So, you know, you've seen China growing at 10% 5 or 6 years back, and I think India is coming into that territory right now.
And what would that mean for the Indian market, which, you know, post this correction has come down to about 13.5, 14 times 1 year forward earnings? Do you think that the bounce back from here could be stronger for India?
Definitely, it'll be much stronger as we go forward. The problem now in India is that we need more earnings, better earnings numbers for many of the companies. As you know, globally, earnings growth has not been very, very good for most countries, including emerging countries. And we'd like to see that come up. And of course, that would be the impetus for more investments.
So what kind of earnings trajectory are you pricing in for India? Because, you know, at 13.5, 14 times, one was expecting that this year would close out with about 15 to 17% earnings. You know, the first quarter does not signal that it's been a great start. Do you think the rest of the year could catch up?
Well, don't forget, we're looking at it in US dollar terms. And in US dollar terms, you're looking at maybe high single-digit growth. We'd like to see it higher than that. We'd like to see it at, as you mentioned, 10, 15% in rupee terms, but in dollar terms, much less. So we'd like to see double-digit growth in these companies. And of course, there are some that are growing at that rate, but we need more of those. What
about the currency? You know, because for a lot of foreign investors, what happens with the currency is also intrinsic to calculating your returns. Do you believe that, you know, the rupee, which has been largely resilient for the better part of this year, you know, with this fall at about 66.50, offers a good investment opportunity for investors to add incremental money if of course, the premise is that the currencies across the emerging world would bounce back from these levels? Yeah, I think the Indian currency now has probably reached the point
where it will be steadier, maybe slightly more weakening, but not significantly. We've already seen most of the weakening take place, at least in this time period. So I'm not too concerned about the currency, and we feel pretty safe going in without having to suffer a lot of currency loss.
What is it that you're most bullish on in India? You know, I was taking a look at your portfolio, and again, I see traditional pharma names, Dr. Reddy's, Infosys, TCS. You know, these are names that a lot of foreign investors like. But I also see oil and gas. I see ONGC, I see Reliance as part of your portfolio. What is the thought process behind looking at the energy space in India?
Well, we're sort of hedging our bets, so to speak. Of course, on the technology side, it's pretty certain that these companies are continuing to grow, continuing to do very well. If you expect the weakening of the currency, then these export-oriented or dollar-earning companies do well. As I said, I don't expect that much more weakening of the currency, so that play for U.S. dollar-earning companies is not that critical. But then we have to turn to commodities and the oil companies. As you know, with the lower oil prices, companies in India that are refining crude oil are doing well. So we have to look at that side of the equation. So we're sort of diversifying our holdings in India with that in mind, so that we have some balance between commodities-oriented companies, export-oriented companies, and domestic companies as well.
What's the call on China? Should we be worried overtly about the region?
I think the Chinese authorities are very clear that they want to liberalize the economy. They want to move towards a market-based economy. And the recent interference that they've made in the equity market was ill-timed and probably an error. And I don't think that will be repeated. The same thing goes with currency. They don't want to have a currency which is controlled by the central bank going forward, because they want to be part of the special drawing rights system. And in order to do that, they've got to have a currency that is freely traded globally. So they're moving in that direction, but it's very, very difficult for them to make a sort of a giant leap in that area, because it will be too disruptive to the Chinese economy and to some extent to the global economies, because if you have a big, big decrease in the value of the renminbi, that would be very upsetting to the U.S. and other countries. If you look at where we are now, we've had roughly a 6% devaluation against the U.S. dollar, and compared to other countries, it's not very much. And I believe they will try to moderate these changes going forward, but the direction is very clear. They want to have a free market currency and a free market country. They want to move in that direction.
So one should look at China as, you know, just an economy which is trying to change its economic model from export-oriented to domestic-oriented, and they have ambitions of getting into special drawing rights, making yuan the next global reserve currency. And to that extent, the authorities in China are doing what it takes to stabilize and protect their own economy. And perhaps, you know, from that point of view, the rest of the world should not be overtly worried about China right now?
Exactly. I think they are going to try to behave responsibly and not create too many waves, so to speak, for the global economy. But they're facing these tremendous challenges because although, you know, the 10-point program is promulgated by the third plenum of the Communist Party was very clear in this regard in moving towards a market economy and liberalizing, getting there is very, very difficult, and they don't want to make sudden steps that would upset the apple cart, so to speak.
Right. Dr. Mobius, where are you seeing opportunity given the sell-off right now?
I think you've got to look at those unpopular sectors, particularly the commodities, because as you know, commodities have come down tremendously. The relationship between actually supply and demand and price is way out of kilter. If you look at oil, for example, the global demand supply doesn't move more than 1 or 2% each year, and within any particular year during the last 20 years, 5% plus, 5% minus. But the actual prices have fluctuated all over the place. So when these prices come down dramatically, you have to think about where we're going in the next 6, 12 months, 2 years, 3 years, and take positions where you believe that these commodities will recover. So I think this is something you have to look at going forward.
So your big bet is commodities, essentially, a rebound in commodities from here.
Yes.
Fair enough, Dr. Mobius. Thanks very much for taking out the time to speak with us
Thank
today.
you.
Really appreciate your views. That's Dr. Mark Mobius, still holding out his conviction for India, believing that the market would stage a stronger rebound than other emerging markets once this market sentiment stabilizes, and would draw in incremental capital from emerging market as well as global funds. On that note, we wrap up the show. Thanks very much for watching.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.